Hey, Ty Miller here with the Portfolio Strategies team at Five Plan Partners. Hope you're doing well, and thank you for joining me today on another educational insight. Today I'm talking about the market's fear gauge. So what is the fear gauge exactly? Well, it has another name in our industry called the VIX, V-I-X, and it's also known as the CBOE Volatility Index. So it's something that we measure. You can track it. If you type in the symbol VIX, it looks like a stock or a bond, even though it is not. It's not a mutual fund or an ETF. It's not a traditional investment, but it is something that can be tracked. And what it tracks is the volatility in the stock market for the next 30 days, the implied volatility, if you will. And so during these times of heightened crisis or heightened turmoil, you'll see a spike in this index. And then in stable markets, it will typically be lower. And so by lower, I mean it may trade usually in a range of 12 to 20 for the last 10 years or so. And that means a pretty stable market where, there's not a lot of moves one way or the other, or some of the moves are to the upside, because we as human beings typically weigh losses about twice as heavily as we would get enjoyment from a gain. And so on the upside, the way that it measures does not fully capture the what you would call volatility. The difference between a 3% upside day in the market and a down 3% upside day, according to this measure, is pretty drastic. Since about 2008, a typical range is about 12 to 20, which indicates a pretty stable, calm market. Anything, kind of north of that is still fairly normal, but once you get above 30, it's kind of when you start seeing times of crisis or turmoil or some uncertainty in the market, if you will. They can be one-day blips or they can be long-lasting items. So if you look in this chart, the times that we see over 30 are times like 2008, where you see above 50 and 60, even in the, getting into the 70s, same thing with COVID, into the 80s. And so when you see that kind of volatility index spike like that means there's a lot of uncertainty in there. I mean, I can think back to 08, of course, how much uncertainty there was in the market at the time. And then COVID, of course, nobody was working. Everything was shut down. There's obviously a lot of turmoil going on, and things were making huge swings in the market. And so that's something that we keep an eye on here. We like to see the volatility in a calmer setting. Volatility is not always bad. I do want to keep that in mind, that it can create opportunities, but that is kind of how to read that index. And again, it's not a stock or a bond or a traditional investment, even though it is something you can track, and it's something that we track here. But again, it just really tells you about the volatility in the market and measures kind of times of turmoil. So thank you for joining me today. I hope this was helpful. Please call or email if you have any questions. Thanks.